Today I want to walk you through some depreciation concepts, including some of the equations you're going to need to know, how to calculate this depreciation through the different methods, as well as some journal entries. So first let's walk through some of the equations you're going to have to know. The first concept we talk about is depreciable cost. Depreciable cost tells us what amount from that piece of asset we're going to actually depreciate. Your depreciable cost is your cost minus your salvage value. Remember, salvage value is what you expect to get once you sell this asset. The second concept we talk about is book value. Book value is going to be your cost minus your accumulated depreciation. We're going to use both of these concepts when we look at the different depreciation methods and try to calculate them. The first method we're going to look at is our straight line depreciation method. The straight line method gives you the same amount of depreciation each year. To get this amount, we're going to take our depreciable cost and we're going to divide that by our useful life. Remember, all of these amounts, your salvage value, your useful life, are just estimates. And these amounts are given to you. The second method we talk about is units of activity. Our units of activity method of depreciation requires two different equations. First, we have to figure out our depreciable cost per unit. To do that, we're going to take our depreciable cost and we're going to divide that by our total units of activity that we expect this asset to use over the whole useful life. And that's going to give us our depreciation per unit. Our next step, step 2, is to take that depreciation per unit and multiply this by the units of activity in that particular year. And that's going to give us our depreciation expense for each year. And the last method we'll look at is our declining balance method. In this method also takes two equations to know. The first thing we have to come up with is our depreciation rate. To get our depreciation rate, we take 100% and we're going to divide that by our useful life. And this again gives us our depreciation rate. Next, we take our depreciation rate and we're going to multiply that by our book value. Remember, book value is your cost minus your accumulated depreciation. This will give you your depreciation expense for the year. So something to note, in units of activity and declining balance, both of these are going to give us different depreciation expense each year, where a straight line would be the same amount each year. One more equation that we need to know, because remember, all of these are just estimates. So sometimes we realize those estimates aren't accurate or we need to change them. So we might want to revise our depreciation. To revise our depreciation, we're going to take our book value, we're going to divide that by our remaining useful life, And that's going to give us our annual or our new annual depreciation expense. Because remember, this is based off of your straight line method where we have the same amount every year. So let's walk through some examples of each of these. First, we'll go over the straight line method. Under the straight line method, move these up. Under the straight line method, first let's review our equation. And I know we just wrote this down, but this is helpful to get you to start memorizing and using these equations in the right format. For straight line, we're going to take that depreciable cost and we're going to divide that by our useful life. To calculate our depreciation expense in this problem that is given, they tell us our cost is $120,000. Our salvage value is $15,000, which is going to give me a depreciable cost of $105,000. We'll use that for all of these problems. Next, I'm going to take my depreciable cost. We're going to divide that by my useful life of 5 years. And that's going to tell me that I am going to depreciate $21,000 each year. When I look at this in a journal entry, I'm going to debit my depreciation expense. I'm going to credit my accumulated depreciation for $21,000. When I look at the whole problem here, it's telling me that after 3 years I'm going to sell this piece of machinery. Therefore, I'm going to calculate my total accumulated depreciation at that point after 3 years. And since straight line is the same amount each year, I can just take that $21,000 times it by 3, and that's going to give me a total accumulated depreciation of $63,000. When I go to sell this item, to record that sale, I want to look at first finding that book value. Book value, remember, is cost minus accumulated depreciation. Therefore, my book value in this situation is $120,000 minus the $63,000, which gives me a book value of $57,000. Oops. Then I can review and see how much cash have I received for this sale. My cash received in this problem is $45,000. The difference between the cash received and the book value is $12,000. Since I received less cash than what my machine is worth, this is going to be a loss on sale. When I put this in a journal entry form, I'm going to record that I received some cash as a debit to cash. I'm going to need to, if I sell this machine, get both. Sorry, I don't know what happened there. If I sell this machine, I'm going to have to get both the machine and the accumulated depreciation off the books. To do that, accumulated depreciation normally has a credit balance, so I need to debit my accumulated depreciation. Remember, my total accumulated depreciation is $63,000. I'm going to need to credit, I'm going to skip a line, credit the machine to say I no longer hold this asset for the full amount. And you can see here that my debits do not equal my credits. I need to input that loss of $12,000. And a loss is a debit. So I debit that loss of $12,000. My debits equal my credits, and I'm done. Next, let's look at what it looks like. The same problem, but let's look at the units of activity. In this problem, remember to do the equation for this. It's a two-step process. First, I need to take my depreciable cost, divide that by the total units, which is going to give me my depreciation per unit. Next, I'll take that depreciation per unit and I'm going to multiply that by the units produced. And that will give me my depreciation expense. So let's look at how we calculate it for this problem. First, I'm going to take my depreciation and my depreciable cost, which we already figured to be $105,000. This problem tells me I'm going to produce in total 210,000 widgets, which will give me a depreciation per unit of 50 cents. The second step of the problem is going to depend on how much we produce each year. So for year 1, the problem tells us that we've produced 80,000 units. I'm going to multiply that by my depreciation per unit for a total expense of 40,000. I will debit depreciation expense, credit that accumulated depreciation for that 40,000. But notice in year 2, I've actually produced 50,000 units. I'm going to times that by my 50 cents per unit, which gives me $25,000 of depreciation expense. I'm going to record that journal entry. Debit depreciation expense, credit accumulated depreciation for $25,000. And then finally in year 3, we've produced 30,000 units. Times that by my 50 cents, which is going to give me $15,000 in depreciation expense. And I will record that journal entry. Now, same problem, we're going to record the fact that we've held this for 3 years before we sold it. So we first need to figure out what is our total accumulated depreciation. To do that, we're just going to add up the depreciation from each year. 40,000 the first year, 25 the second year, and $15,000 the third year, for a total accumulated depreciation of $80,000. When I go to record the sale, first thing I'm going to do is find that book value, so I can compare that to the amount of cash received. Your book value again is cost minus my accumulated depreciation that I just figured out. So my book value is 40,000. The cash I received is 45,000, which gives me a difference of $5,000. Now, since the cash I received is higher than the book value, This would be a gain on sale. When I go to record the journal entry to record this sale, I again debit my cash. I'm going to debit my accumulated depreciation to get that off the books, $80,000, and I'm going to credit that gain on sale. Gain on sale was $5,000, and I need to get rid of the machine, closing out the machine and closing out the accumulated depreciation is just like when we were doing all of those closing entries back in chapter 4. So I make sure my debits equal my credits. They do, which means I probably did it right, and then we can move on. Our last depreciation method is the double declining balance method. Your book is just calling this the declining balance method because we only teach you one. To do this, again, a two-step process. First, let's go over those equations. You're going to take 100%, divide that by your useful life, and multiply that by 2. That's where the double part comes in. That's going to give you your depreciation rate. We're going to take that depreciation rate and multiply this by our book value to get our depreciation expense. It's going to change each year. So let's look at how we're going to do that for this problem. We're going to figure out what is our depreciation rate. We're going to take that 100%, divide it by my useful life, which is 5 years, and multiply all that by 2, which gives me a depreciation rate of 40%. Since this is going to change each year, I'm going to calculate my depreciation by year. In year 1, I'm going to take my book value, which in year 1 is your cost, because I have no accumulated depreciation, multiply that by my depreciation rate, and I will get my depreciation expense. I'm going to then do the journal entry I need to do and record that depreciation expense for that year. In year 2, it's going to look a little different. I have to find my book value. Remember, book value is cost minus accumulated depreciation. I only have 1 year of accumulated depreciation so far, so I'm just going to record that and multiply that by my depreciation rate. So in year 2, my depreciation expense is $28,800, and I record that in my journal entry. And finally, let's look at year 3. In year 3, I take my cost minus my accumulated depreciation, which is now $76,800. I get this by taking the accumulated depreciation each year, the $48,000 and the $28,800. And I'm going to add those together. I'm going to figure out that that equals $43,200, and I'm going to multiply that by my depreciation rate. And that's going to give me $17,280. And then I can record the journal entry. For $17,280. before I sell it, I need to find out what that total accumulated depreciation is so far. To do that, I'm just going to add up everything that I've recorded. 48,000, 28,800, and that's 17,280. When I add all those up, it comes to 94,080. So before I record the sale, first step is to find that book value, which is my cost minus my accumulated depreciation. So that should be, which comes to 25,920. This is my current book value. I'm going to compare that to my cash received, which was 45,000, and the difference is 19,080. The cash I received is greater than the book value, so that will be a gain on sale. When I record this, again I record the cash, not going to change. Record that accumulated depreciation, the total amount that I have in my books of 94,080. I'm going to record as a credit that gain on sale, 19,080, and then of course that final credit to get the machine off the books of 120,000. You can see my debits equal my credits, and I'm done. So that's a good example of each of those three methods, both in the depreciation method and how to record that, as well as recording the sale. Let me know if you have any questions.